Welcome to our comprehensive guide on margin and margin trading. In the world of investing, margin trading is a powerful tool that can amplify both your gains and your risks. Today, we'll break down what margin means, how margin trading works, and why it's such a hot topic among investors. Whether you're a beginner or looking to deepen your understanding, this video will walk you through the essentials step by step. We'll also cover real-world examples, key regulations, and the pros and cons you need to know before diving in. Let's start by defining what margin is and why it matters in the financial markets. Margin is essentially the collateral that investors deposit with their brokers to cover potential losses. It allows you to borrow funds from your broker, giving you the ability to buy more assets than you could with your own cash alone. This borrowed money can be used for various financial activities such as buying stocks, short selling, or trading derivatives. While margin can boost your purchasing power, it also introduces significant risks. If the market moves against you, you could face losses greater than your initial investment. Understanding margin is the first step to using it wisely. Margin trading involves using borrowed funds from your broker to purchase securities. To do this, you need a margin account, which is different from a standard brokerage account. In a margin account, your broker lends you money using your existing cash or securities as collateral. This means both your potential gains and losses are magnified. If you anticipate earning a higher return than the interest you pay on the loan, margin trading can be advantageous. However, if the market turns against you, your losses can quickly add up, and you may even owe more than your initial investment. Start margin trading, you must open a margin account with your broker. This account is separate from a regular cash account and requires an initial deposit which acts as collateral. The broker will lend you money based on this deposit, allowing you to buy more securities. Regulations from organizations like FINRA and the SEC set strict rules on how much you must deposit and maintain in your account. It's important to understand these requirements before you begin, as failing to meet them can result in forced sales or additional fees. Buying on margin is like taking a loan from your broker to purchase stocks. First, you deposit cash into your margin account, which serves as collateral. Then you can borrow up to 50% of the purchase price of an investment. For example, if you deposit $5,000, you could buy up to $10,000 in securities. Your broker charges interest on the borrowed amount, and when you sell your securities, the proceeds first pay off your loan. Any remaining funds are yours to keep. This process allows you to leverage your investments, but it also means you're taking on additional risk. Before you can start trading on margin, brokers require a minimum deposit, often at least $2,000, though some may ask for more. This is known as the minimum margin. It's a legal requirement designed to protect both you and the broker from excessive risk. The minimum margin ensures you have enough equity in your account to cover potential losses. If your account falls below this threshold, you may face a margin call, where you'll need to deposit more funds or sell securities to restore the required balance. Initial margin is the portion of the purchase price you must deposit when buying securities on margin. By law, you can borrow up to 50% of the purchase price, but you can choose to borrow less. Some brokers may require a higher initial margin depending on the security or market conditions. The initial margin acts as a buffer, ensuring you have enough equity to cover potential losses. You can keep your loan as long as you meet your obligations, such as paying interest and maintaining the required account balance. Maintenance margin is the minimum account balance you must maintain to avoid a margin call. If your account value drops below this level, your broker will require you to deposit more funds or sell securities. This process is known as a margin call. If you fail to meet the margin call, your broker can sell your holdings without your approval to bring your account back to the required level. This can result in losses, and you're responsible for any shortfall. If you borrow money from your broker to trade on margin, you'll be charged interest on the loan. These interest charges can add up over time, especially if you hold your investments for a long period. The longer you keep the loan, the more you'll pay in interest, which can eat into your profits or increase your losses. It's important to factor in these costs when deciding whether margin trading is right for you, as they can significantly impact your overall returns. Margin trading is closely regulated by organizations like FINRA and the SEC. These agencies set rules on how much you must deposit, how much you can borrow, and the minimum balance you must maintain. The regulations are designed to protect investors and maintain stability in the financial markets. Brokers are required to obtain your consent before opening a margin account and must follow strict guidelines to manage risk. Always make sure you understand the rules and your broker's policies before trading on margin. While margin trading can increase your potential returns, it also exposes you to greater risks. If the value of your securities declines, you could lose more than your initial investment. Margin calls can force you to deposit additional funds or sell assets at a loss. Interest charges add to your costs, and if you can't meet your obligations, your broker can liquidate your holdings. It's crucial to fully understand these risks before engaging in margin trading. Margin trading isn't suitable for everyone. It's generally recommended for experienced investors who understand the risks and have the financial resources to cover potential losses. If you're new to investing or have a low risk tolerance, margin trading may not be the best choice. Always assess your financial situation and investment goals before deciding to trade on margin. Margin trading is typically used for short-term investments. The longer you hold an investment on margin, the more interest you'll pay, which can reduce or even eliminate your profits. For long-term investments, the odds of making a profit decrease as interest charges accumulate. That's why many investors use margin for quick trades rather than holding positions for extended periods. Not all securities can be bought on margin. Stocks, ETFs, and some bonds are typically marginable, but penny stocks, IPOs, and certain other investments are often excluded due to their high risk. The Federal Reserve Board regulates which stocks are marginable, and individual brokers may have additional restrictions. Always check with your broker to see which securities are eligible for margin trading. Significant margin call can have a ripple effect across the market. If a major investor is forced to liquidate holdings, it can drive down the value of those securities, potentially triggering margin calls for other investors. This domino effect can lead to increased volatility and further forced sales, amplifying market declines. Understanding this risk is important for anyone considering margin trading. Main advantage of margin trading is leverage. By borrowing money, you can increase your purchasing power and potentially earn greater returns. Margin trading also offers flexibility, as there may not be a fixed repayment schedule. If the value of your collateral increases, you may be able to borrow even more. For experienced investors, margin trading can be a powerful tool to maximize opportunities in the market. On the flip side, margin trading can amplify your losses just as much as your gains. If the market moves against you, you may owe more than your initial investment. Interest charges and account fees can add up quickly, and margin calls may force you to sell at a loss. It's essential to weigh these disadvantages carefully before deciding to trade on margin. Leverage is the core concept behind margin trading. It allows you to control a larger position with a smaller amount of your own money. While this can lead to higher profits if the market moves in your favor, it also means your losses can be much greater if things go wrong. Leverage is a double-edged sword, and it's crucial to use it responsibly. Margin call occurs when your account value falls below the required maintenance margin. Your broker will ask you to deposit more funds or sell securities to restore the balance. If you can't meet the margin call, your broker can liquidate your holdings, often at a loss. Margin calls can happen quickly, especially in volatile markets, so it's important to monitor your account closely. If you fail to meet a margin call, your broker has the right to sell your securities without your approval. This process is known as forced liquidation. The broker can choose which positions to sell, and you're responsible for any losses that result. Forced liquidation can be costly and may leave you with a negative account balance if the sales don't cover your debt. Interest expense is a key cost of margin trading. Brokers charge interest on the money you borrow, and these charges apply regardless of your account's performance. Over time, interest can significantly reduce your profits or increase your losses. Always factor in interest expenses when calculating your potential returns from margin trading. Let's look at a practical example. Suppose you deposit $10,000 in your margin account. With a 50% margin requirement, you now have $20,000 in buying power. If you buy $5,000 worth of stock, you still have $15,000 in buying power left. You only start borrowing when your purchases exceed your cash deposit. Remember, your buying power changes daily as the value of your securities fluctuates, so it's important to keep track of your account balance. Buying power in your margin account isn't static. It changes every day based on the price movements of the securities you hold. If your investments increase in value, your buying power goes up. If they decrease, your buying power drops and you may get closer to a margin call. Monitoring your account regularly is essential to avoid surprises and manage your risk effectively. Margin isn't just for trading. In business accounting, margin refers to the difference between revenue and expenses. Companies track various profit margins, such as gross profit margin, operating margin, and net profit margin. These metrics help businesses understand their profitability and make informed financial decisions. Understanding margin in this context is important for both investors and business owners. Gross profit margin measures the relationship between a company's revenues and the cost of goods sold. It's a key indicator of how efficiently a company is producing and selling its products. A higher gross profit margin means the company is keeping more of its revenue as profit after covering production costs. This metric is widely used by investors to assess a company's financial health. Operating profit margin takes into account both the cost of goods sold and operating expenses, providing a broader view of a company's efficiency. Net profit margin goes even further, factoring in all expenses, taxes, and interest. These margins help investors and managers evaluate how well a company controls its costs and generates profit from its operations. Mortgage lending margin refers to the portion of the interest rate added to an adjustable rate mortgage arm. The bank adds a fixed margin to an index rate to determine your total interest rate. For example, if the index is 6% and the margin is 4%, your mortgage rate becomes 10%. The margin typically remains constant while the index can fluctuate over time. Trading on margin means borrowing money from your broker to buy more securities than you could with your own funds. You deposit cash as collateral and pay ongoing interest on the borrowed amount. The securities you purchase serve as additional collateral. This strategy increases your buying power but also your exposure to risk. It's a common practice among active traders seeking to maximize returns. Margin call happens when your account equity falls below the required maintenance margin. Your broker will notify you to add more funds or sell securities to restore the balance. If you don't act quickly, your broker can sell your assets without your consent. Margin calls are often feared by investors because they can force you to sell at unfavorable prices, locking in losses. Outside of margin trading, the term margin is used in various financial contexts. It can refer to different types of profit margins, such as gross, operating, or net profit margin. Sometimes margin is also used to describe interest rates or risk premiums in lending. Understanding the context is key to interpreting what margin means in any financial discussion. Investing on margin carries the risk of losing more than you deposited. If the value of your securities drops, you may have to provide additional funds or face a forced sale. This can result in losses that exceed your initial investment. Margin trading is not for the faint of heart and requires careful risk management and a solid understanding of the market. While margin and leverage are closely related, they're not the same. Margin is the collateral you deposit, while leverage is the act of using borrowed funds to increase your investment size. Leverage magnifies both gains and losses, making it a powerful but risky tool. Understanding the distinction helps you make smarter investment decisions. Margin account allows you to borrow money from your broker, while a cash account only lets you trade with the funds you have on hand. Margin accounts offer greater buying power but come with higher risks and additional requirements. Cash accounts are simpler and safer, making them a better choice for most beginners. Interest rates on margin loans vary by broker and market conditions. Some brokers offer competitive rates while others may charge more. It's important to compare rates and understand how they'll affect your returns. Even a small difference in interest rates can have a big impact over time, especially if you hold positions for longer periods. Margin trading is also available in some cryptocurrency markets, but it's often more restricted due to high volatility. Not all exchanges allow margin trading for crypto, and the risks can be even greater than in traditional markets. Always check the rules and understand the unique risks before using margin in the crypto space. Federal Reserve Board regulates which stocks can be bought on margin and sets the minimum margin requirements. These rules are designed to limit excessive risk and protect both investors and the financial system. Brokers must comply with these regulations, and investors should be aware of them when opening a margin account. Individual brokerage firms may have their own policies regarding margin trading. Some may require higher initial margins or restrict certain securities. It's important to read your broker's terms and understand their specific requirements before you start trading on margin. These policies can affect your ability to trade and manage risk. Market volatility can increase the likelihood of margin calls. Rapid price swings can quickly erode your account equity, triggering margin calls and forced liquidations. It's important to be prepared for sudden market movements and have a plan in place to manage your risk. Staying informed and monitoring your account can help you avoid costly surprises. Margin accounts are required for short selling, which involves borrowing securities to sell them in hopes of buying them back at a lower price. Short selling carries its own risks, including unlimited potential losses if the price rises. Margin requirements for short selling are often stricter, and brokers may impose additional rules to manage risk. Margin is also used in derivatives trading such as options and futures. In these markets, margin acts as a performance bond, ensuring both parties can meet their obligations. The rules and requirements for margin in derivatives trading can be complex, so it's important to understand them before participating in these markets. Let's address some frequently asked questions about margin trading. What does it mean to trade on margin? It means borrowing money from your broker to buy more securities. What is a margin call? It's a demand from your broker to add funds or sell assets when your account falls below the required balance. What are the risks? You can lose more than your initial investment, and forced sales can lock in losses. Margin trading is a powerful tool, but it's not without significant risk. Margin isn't just for trading. In finance, it can refer to profit margins, interest rates, or risk premiums. In accounting, it's the difference between revenue and expenses. In lending, it's the extra percentage added to an index rate. Understanding these different uses helps you navigate financial discussions more confidently. What are the main risks of trading on margin? The biggest risk is losing more than you deposited. If your investments decline, you may have to add more funds or face forced sales. Interest charges and fees can add up, and market volatility can make things worse. Always understand the risks before using margin. Margin trading allows investors to amplify both gains and losses by borrowing money to invest. It requires a margin account, an initial deposit, and ongoing interest payments. While margin can boost your returns, it also increases your risk and can lead to losses greater than your initial investment. Understanding the rules, risks, and costs is essential before getting started. Conclusion: margin trading is a powerful investment strategy that can offer significant rewards but also comes with substantial risks. It's essential to understand how margin works, the regulations involved, and the potential for both gains and losses. Always assess your financial situation, risk tolerance, and investment goals before using margin. With the right knowledge and careful planning, margin trading can be a valuable tool in your investment toolkit.